welcome to Investors Hangout. This fortnightly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, the deadline for making tax-saving investments for 2021-22 is fast approaching, and anyone who hasn't done it yet is wondering which is the best option. And to help us with that, we're joined by our CEO, Dhirendra Kumar. Welcome, Dhirendra. When it comes to tax-saving options, there are so many options available in the market that an investor, ends up being confused where to invest. So, what is your view on that?
Yes, there is a problem of plenty. But to simplify things, I think one should look at the bunch of things that you can invest in, and then my sense is that 1.5 lakh rupee which you can invest. Which you can invest to save taxes. They are normally filled up with all the mandatory things. If your provident fund is getting deducted, then there is a possibility that a good part of it will be filled by that, and that is the regular monthly deduction. But that apart, if you have any discretionary, if you have a choice of investing in any of this, I think it's important to understand what all, broadly what they stand for, what you should expect, and what are the constraints. One is that you're on the extreme conservative side. You have the public provident fund, post office deposits, and a post office 5-year deposit, and bank deposit. Tax saving deposit. They all come with a 5 to 15 year public provident fund with 15-year term, and then the normal deposits, the bank deposits and others, 5-year. So understand this, that you are going to get a fixed income. The income that you will get will, the money that you invest will be tax sheltered, but the income from that investment will be taxable. And it all comes with a minimum lock-in of 5 years. Then you have these hybrids. Hybrids meaning the ULIPs, and also the retirement plans offered by the mutual fund. They are structured as a hybrid only, and they are also eligible investment. So here you get a combination of equity, fixed income of different kind combined, coupled with insurance. And when you mix all of it, you get the worst of all, or you don't get the finest of it. I would not say the worst of the lot. So. And then on the other extreme are the equity fund, which comes with a minimum, the least lock-in period of 3 years. And they are all equity. They actually hold the greatest promise of delivering you the highest return. But highest return may not necessarily be everybody's goal. If you are going to retire after 5 years, or in 3 years, and then you are likely to need that money, or 4 years or 5 years, then maybe the fixed income alternatives might be a better alternative. But I think for most investors who have any time frame of 5 years and more, invest in the tax saving fund, because they hold the greatest promise, and the mandatory 3-year lock-in period tends to make your experience more rewarding. And because most of the time, investors are perturbed. They are hurt by the whole thing, because the moment you invest, and if you see a market decline, and then you see you are not used to the market's wildness, so you tend to run away. And the fact that you are forced to be with the fund for 3 years, that itself does the job. So what looks like a constraint is a great advantage. So, and apart from this, you have some eligible expenses, your child's education, the tuition fee that you pay, and for 2 children, that can also be an eligible investment. So this limit hasn't gone up for many years, while the inflation has gone up. So I would say that 1.5 lakh rupee for many people may not be meaningful. It has not gone up. And then the provident fund deduction or the tuition fee. So most of the things in the organized sector is taken care of, or it gets filled up with most of the statutory things. So I would say that whatever you are left with, you must invest, because tax saved is money earned. And then if you are able to grow it well, it might, I would like, most investors to try it out, avail this at least with a small sum, 5,000, 10,000 rupees. Simply because, it takes time to get used to equity. And if you get used to equity through this vehicle, it is a nice vehicle, because, you are forced to stay there for 3 years. And if you stick around for 5-7 years, I think you don't have to listen to our videos. You will, because it becomes self-evident unless you experience it, unless you see your money growing rapidly, or going with all the all with the usual characters turns out to be rewarding, and that is very important.
Within equity also there's ELSs, there is NPS, then there are hybrid ULIPs. So which one out of them you're saying ELSs is a better option, is it?
No, you have these three alternatives which will have some kind of a degree of equity in it. Tax saving funds are the only ones which will be fully into equity. The next comes the NPS, National Pension System. ELSS, the tax saving funds, there's a lock-in of 3 years. The NPS, that is linked to your age when you retire or 58. So that's the second thing. But there the maximum equity allocation that can happen is 75%. You cannot make, your money cannot be fully invested in equity. And then the ULIPs are a combination of everything, equity, debt, and insurance. And when you combine all of it, you don't get the finest of each.
And what about the fixed income options? Should one invest in the 5-year bank fixed deposits?
That is one of the alternatives. But most people, your grandparents actually tell you to open a PPF account. So that will be a legacy holding. And that also turns out to be good on two fronts. One is that they are high yielding. Sukanya Samriddhi Yojana is the highest yielding. And PPF is 7.1%. But you are stuck for 15 years. And you can take a part of it after 5 years. But more importantly, this is the only fixed income investment from which the return that you get is completely tax-free. So that is a great charm. So if you have your PPF account on, and if you are a very conservative investor, continue investing. If you want more return, go to tax saving funds, the ELSS. Next comes, if you're saving for your, girl child, then Sukanya Samriddhi Yojana is a better substitute to public provident fund. And then I think, one should not be considering, the tax saving fixed deposits or the 5-year post office deposit, simply because, the income is taxable. The returns are not very high. And you get stuck for 5 years. If you get stuck for 5 years, might as well take the risk. And you run the potential of, getting substantially twice as much as the fixed income on any 5-year holding period with an all equity option.
And what about the insurance plans that, promise guaranteed returns and money back schemes, all of them? What's your opinion about them?
My opinion is that most people, don't buy these things objectively. Somebody gets after your life and you end up buying it.
Yeah.
And once you buy it, then you get stuck because, they are supposed to, you're supposed to continue it. And people also have, this mindset that, okay, this is a policy and you have to pay this premium. Your contribution is called premium. A small part of it goes towards insurance. And because they guarantee return, the returns are very low. And so I would say that, people should look at their insurance need independently. They should not mix their insurance, tax saving, and all this mix of a very confusing mix of insurance, investment, and the return, with all kind of different expressions used. The bonuses and this and that, and you can't objectively measure it. So my sense is that if you not only people should not invest in this, if you have any, go for your term insurance and methodically go about surrendering these.
Okay. Well, time now to move on to our viewers' questions. The first one has been sent in by Sudhakar K. He plans to invest 1 lakh rupees every year in sovereign gold bonds and over the next 15 years. Will it be able to beat inflation?
I was looking at this question and, I looked at, at Value Research Online. I went to the fund which has the longest history, which is now called, Nippon Gold Bees. So that is an ETF and longest history. And if you would have done a SIP in this fund, you would have made, if you would have invested at the outset, you would have earned about little over 10%, which is a very handsome return. You have beaten the inflation. But when I look at the last 10 years and your SIP return, you invested and your money did not earn any return for the first 11 years. All the return that has come in the last 4 years. And which means that gold has turned out to be a very erratic investment. Not only that, when I look at the worst performing periods for gold funds, this particular fund itself, which has the longest history, the worst week performance return was minus 13%. Gold prices can go down by 13% in a week's time. The worst annual return in the life of the fund, the worst 365 days,
was from 28th August 2013 to 28th August 2014. It fell by 20%.
The point is that most people have this innate sense that, investing in gold, so it's gold. It's not gold, it's just another asset which has become volatile. In fact, gold is not supposed to be beating inflation. It has nothing in its character which is supposed to beat inflation, because to beat inflation it should be linked to real economy. This thing actually sits in your locker. The primary driver for gold is demand supply, seasonal supply, central bankers buying, so that is one. And the only occasion when gold is actually fancied asset, when there is, blood on the street, the fixed income is actually, market is crashing, and people are scared of equity, people are worried about fixed income because there could be bankruptcy, they may not get their money back, they have invested in a bank deposit or bonds and things like that. So when there is calamity, gold gets fancied. And I think, if you are positive about the future of the world, if you're optimistic, you should not be investing in gold. Look at gold as a consumption. You feel happy about it. There are a lot of ceremonial opportunity when you actually can show off and actually feel happy that you own this asset. And it could well be a jewelry, is a form which can actually come in a very lean time in your personal context. But I don't think one should look at it as an investment, as a long-term investment.
All right, so one can actually skip sovereign gold bonds as well. All right, then Bhushan Sachdeva asked, how can a senior citizen generate a post-tax return of 10% on his investments?
To generate a post-tax return of 10%, if you're in the 30% tax bracket, you need to earn nearly close to 15%. 20%, then accordingly, earn less, and so on and so forth. If you're not in the taxable bracket, then you need to generate 10%. Now the point is that what will generate 10%? Nothing which is no fixed income alternative will generate 10% for you. The highest fixed income alternative for retired people with a ceiling of 15 lakh and so on and so forth, 2-3 options, that's not going to earn you more around 7%, which means and if you definitely need 10%, you need to buy you have to buy into equity quite substantially. Now, how much equity? Try and buy as little as possible. But the point is that, it could be 20%, it could be 30%, it could be 40%, but that 20, 30, 40, 50, 60% entirely depends on your scale. Because if you have 50 lakh rupees of capital and you definitely need 5 lakh rupees per annum, then I think there is a problem. The problem, this problem will get solved only if you have little more than enough. If you have 1 crore of rupees and you need 5 lakh rupees, things get easy. If you have 1.2 crore, it gets even easier. Maybe it can support even higher income. I would like to give one more context to this, that 10% or 11% or 9%, all these numbers are very relative numbers. It is all in line with the inflation. But if you have a fixed need of 10% from your investment, then you have to really understand that if interest rates go down, if inflation goes down, then these returns will also go down. And if they go down, how will you actually manage? Because if your definite requirement is 5 lakh rupees, so I would say that the only sensible choice is equity allocation. Try and manage with least as possible. Try and build up as much cushion while you're in your accumulation phase, and that's the only way out.
Astha wants to know, where should one invest for child's education? Are child education plans by mutual fund companies good?
I would say that, don't get carried by the nomenclature. If you are investing for your child, any investment and made for your child, and you don't fiddle with it, you're not indisciplined and to actually lay your hands on that, any investment is your child fund. Now, what kind of investment is meant for will be appropriate one for your child? If you're the young child, have as much into equity, maybe take, and if you're an experienced investor, take as aggressive exposure as possible. If you're getting closer to the requiring that money, your child is you have accumulated it for 10-12 years, and your child is likely to get into college, and that will be, and you want to prepare for that. Maybe prepare, with a 3-year lead, with a 3-year lag. take out the money that is needed in the first year of the college 3-4 years ahead of time, then the second year's money a year later. So you will not be dependent on the state of the market when you actually need it. And this is a broad principle which one should follow.
And are child education plans by mutual fund companies?
Oh, they don't make sense because there are unnecessary constraints, but they actually fulfill the need of a naive investor. Because many people think that if it's a child fund and I'm investing for the child, it makes sense. But there is absolutely no disadvantage. If you are capable of choosing a good fund and you are disciplined enough, any fund is a child fund. Any fund could well be a retirement fund.
Okay. The next question has been sent in by Paritosh Chaudhary. His father had invested about 50 lakh rupees in capital gain bonds after selling his land few years back. They are now nearing maturity. So where should he invest the proceeds? He's not dependent on this money for income.
This is money for the long term. And I think, this is, he should be guided entirely by his father's experience. If he has never invested in equity, then he should invest the money into an equity income fund or conservative hybrid funds. If he has experienced equity, then maybe go for aggressive hybrid fund. That way the money, because this money is for the long term, but never invest dominantly into equity fund if you don't have experience, because as you get older, your experience, your reaction to big swings in the market value of your investment has an impact on your behavior, and that could hurt.
All right. Now, Mayur Goswami has a lump sum of 12 lakh rupees, which he wants to invest for 3 to 4 years. How and where should he invest? Should he invest them in a debt fund and initiate an SIP through STP? The aim is to generate wealth.
Generate wealth and only 3 to 4 years, that's my worry. You are not going to get wealthy in 3 to 4 years. Equities generate superior return, but they require longer time frame, 10, 12 years, 15 years. If you don't have that much time, then you have to be extremely conservative. If you are likely to need a meaningful part of this money in 3-4 years time, then you have a problem at hand, which is you should be extremely conservative. I don't think one should even if it is for a negotiable goal, one should move any further than, move ahead any further than equity income fund or conservative hybrid funds.
Should he invest them in a debt fund and initiate an SIP through STP?
No, if you are actually going to invest in a conservative hybrid fund, because they are dominantly fixed income, then maybe, spread this money, because you don't have too much time, 3-4 years time, and if you're going to spread this money over the next 12 months, 18 months, then half of the time is gone. So spread this money over the next 3-4 months and into a conservative hybrid fund.
All right. Now, Jeevan Dabra wants to know if it's better to invest in a large and mid-cap fund or to invest separately in funds of both these categories. Also, which is the better option between a multi-cap, flexi-cap, and a focused fund?
It entirely depends on the amount of complexity you can assume in your investment. And it gets difficult with investors, because it's a little problematic in the sense that if you invest in a large cap fund, mid cap fund, and small cap fund, you are getting diversification. But the options can change. The best fund could be, and it can get magnified. And if you try and rebalance it on an annual basis, that may not be appropriate, because many a times 1 or 2 year returns could be disappointing, and after that the returns could just go ballistic. So what is true about equity is that it grows like bamboo. For many years it won't grow, and then suddenly it will go up by 100%, 200%, 300%, and that is how you actually end up getting these returns. And if you are following any method, any principle, any mathematical rule, you will just be juggling around. My sense is that somebody should assume that risk or entrust it to somebody who knows it. So your flexi cap, multi cap, and focused fund, they are of similar kind. They are achieving the goal in a similar fashion. There is a case for multi-cap and there is a case for flexi-cap. Flexi-cap funds have the great flexibility. Fund manager can invest anywhere. But then some of the flexi-cap actually face a very severe constraint that as these funds get very big, they stop taking exposure to small caps and mid caps, because 20,000 crore fund, 30,000 crore fund, and if you have to take even 10%, 15%, that turns out to be huge and bigger than many of the small cap funds that we have. So with that in mind, I think the multi-cap fund they turn out to be better, because they are forced to invest a certain allocation into all the categories. And then the focused fund, where a fund manager is taking a bet on few companies, taking a meaningful bet, and if he goes right, then actually this can prove to be rewarding. But then I really wonder that that's a diversified yet concentrated bet in few companies. It'll have its advantages and it'll have its disadvantage, and it'll definitely turn out to be more volatile. So choose one of these, because they are the more flexible ones. But if at all you are, it depends on, as I said, that it depends on how much complexity you want to assume. You can well have a large cap, mid cap, and small cap fund on your own, and value research will help you choose the finest one at any given point. For the large cap fund, I would say the choice is very simple. Choose the largest and the cheapest index fund. You are at least assured, and then large cap should be a sizable part of your allocation, long-term allocation, which could be about 40, 50, 60%, depending on how much you want to assume. Remaining money you choose, you invest in one or two mid cap and one or two small cap, and this way it will be diversified. I would say that rebalance your money on a 3-year basis. Don't do it on an annual basis, so that you are giving some money, some time to all these assets, because many times small caps don't do well, and when you're just about to give up, they will go up, and that is what happened last year. In the last 1 year, small caps have turned out to be, or maybe about 1.5, 2 years, they've turned out to be the most rewarding asset segment. But the 3-year prior period was the worst phase of this fund, and what has happened in the last 1.5 years has more than compensated for the disappointing returns of the erstwhile period. So I would say that give it some time, be passive about it, keep investing your money in that certain ratio, increase your small cap and mid cap as you get used to it, because if you have more time on your side, if you are investing for 10, 15, 20 years, maybe have larger small and mid cap allocation.
All right. Ajay asks, how diversified is the equity portion of a hybrid fund? Does it invest in all market segments, large, mid, and small cap?
Some do, and some are, same constraints as the flexi cap or multi cap I was referring. When a hybrid fund, gets very large, the small cap exposure actually comes down. Mid cap exposure gets reduced substantially. So take a look at the portfolio and take a look at the consistency of because there are two things which drive the performance of a hybrid fund. One is the discipline of asset allocation, restating the asset allocation, rebalancing. And the other is being right, or being, good with your equity investment. So I would say that, most investors should look at the portfolio and review that portfolio every year, because these funds actually change their characters. Fund is not something that you take a look at it and it looks like this and it won't change. It's not going to remain that way, because more and more investors are putting their money, and the fund manager is forced to invest, and then he's supposed to actively manage it, and that changes its character. So they change. They could be widely different, and choose a fund. I would say that a fund which has a greater discipline and which is more diverse should be the choice.
Apurva Gaurav asks, how should one divide the monthly investment in mutual funds if the amount exceeds 50,000 rupees?
Once again, I would suggest that it entirely is a function of complexity you want to assume. This 50,000 or 5 lakh rupees or 1 lakh rupee or 5,000 rupees. Based on the scale, there could be a complexity that you can't invest in too many funds with your 5,000 rupee or 10,000 rupee. With 50,000 you can, but I would say keep it simple. Even 2 good flexi cap fund will do the job. And if you want to make it a little more complex, then buy 3, add 2 more small cap fund to it. If you are investing for 10 years and more, so complicate it to your liking. But start with simplicity, in as simple manner and keep it as least complex. Keep it least complex to begin with.
Today's last question has been sent in by Raj Krishnamurthy. He wants to know, like one buys equity mutual fund units as market dips, what is the best time to invest in debt mutual funds?
You don't really need to time your investment in debt mutual fund. When investing in debt mutual fund, you can well invest lump sum. Ensure that that fund is safe enough. It is invested in securities which is safe enough, and you are choosing the appropriate kind depending on the time frame that you have. There are many investors who invest in fixed income for the long term, debt funds for the long term. But if his first assumption that one should be buying equity on dips, it's well said, and it looks nice, but it's very difficult to do it. You don't know whether this dip is the final dip, and it will not dip further, or this dip is a temporary one, or it will linger. So I would say that most investors should implement some kind of disciplined strategy. You are investing X amount every month. Maybe have some kind of allocation for trying to target the dip. But because if you miss that, because the biggest risk which comes with trying to look for that dip is that you will miss some of the big moves. And most big moves happen when you least expect it. The big declines, they come with as a surprise, and the big up moves also come with a surprise. In fact, people should take note of that the biggest gain that we have seen in recent times was from the low of March 2020, and market went ballistic while nobody expected it to. So, and everybody was in awe and surprise of that big surge that happened. And it is always like that. You will have the big declines coming for a brief period, and you will have the big surge that will happen. And that is when most investors who are waiting on the sidelines, waiting for that dip, actually miss out.
Yeah. Well, with that, it's a wrap on this episode. Thank you, Dhirendra. Thank you to all our viewers. Do keep sending in your questions. Keep watching this space for more information. And if you like the show, do subscribe to our YouTube channel. Thanks for watching. Bye for now.